Hello and welcome to my morning note. Let's take a look at the long view today. We've recently seen the publication of this fascinating piece of annual research, the Credit Suisse Global Investment Returns Yearbook, produced by Professors Elroy Dimson, Paul Marsh and Mike Staunton. It covers global investment returns over a range of countries going back more than a century, and many asset managers can't live without it. With me now to discuss some of the more interesting and worrying implications from the report is Professor Elroy Dimson. Elroy, thank you very much for being here today. What we're going to take a look at is whether we can time the market using mean reversion. And if we take a look at one of your central slides, it looks as though you can indeed go on the basis of buying when you're below trend and selling when you're above trend. What's wrong with that?
Well, indeed, Joel, we have data for lots of different countries, but the US would be the one that is most frequently looked at. And so what this chart portrays is the performance of the market, including reinvested dividends, from the start of 1900 to the beginning of this year, the beginning of 2013.
With a very clear trend, obviously.
There's a very clear trend, and when we have one of these logarithmic scales, the slope of the line represents the annualized rate of return that we achieve. And so if you have a look at that trend, it's a plausible trend of a little over 6% per year in real inflation-adjusted terms. And it's clear in retrospect that there were some times where you ought to have been taking action.
Okay, so now let's take a look, however, what happens if you'd built that trend to the year 2000, obviously one of the great times to sell in history.
Well, at New Year 2000, everybody was interested in equities.
Yeah.
So at New Year 2000, we would have been drawing our line up to this point, and then we'd be projecting that trend line forward. And what we would have seen is that compared to trend, which would have continued upwards, we were slipping behind. So stocks were getting cheap. You should have been loading up through the 2000s, which, as we all know, would not have turned out to be particularly wise.
And it can work the other way as well. Let's now take a look at what would have happened if you'd taken the trend through to the early 70s.
Yeah, so after the mid-70s, after the oil crisis, stocks were at an all-time low. But we could look back and estimate what the long-term trend looked like. And then what that would tell us is that if stocks end up being above trend, that's time to get out. So we would have been selling out, and we would have been leaving out from our investment experience the really great years, the 80s, the 90s.
Okay, now let's take a look at a famously mean reverting valuation series. This is the cyclically adjusted price earnings multiple, which you'll have heard me talk about a lot in the future. There was a very famous sell signal in 2000. At your point.
Indeed. So when price earnings multiples were very high, it's obvious, isn't it, with hindsight, that we should have been getting out of equities. But how do you do that in real time? One way you might do it is to look back over a long period and see when it's high. And when we'd surpassed the level seen in the 60s, the 50s, since the Second World War, any time since the Wall Street crash, this was the time to sell, and you would have missed out on all of the benefits of the tech bubble in the late 1990s.
All very alarming. Now let's take a look. This is a quite extraordinary piece of research from the Dimson, Marsh and Staunton database. Take us through. The blue bar is when you try to time the market using mean reversion, and the red bar is when you just buy and hold, as I understand. Take me through how you produced this chart.
What we do is we create a forecasting model using data up to a particular day.
Right.
So if we want a forecasting model in, say, 1970, we use data available only up to 1970. We use that to decide whether stocks are over or underpriced, and make a decision for the course of that calendar year. And we keep updating that process. So at times that takes you out of the equity market. And if you have a look, well, have a look at Austria. Austria did not perform particularly well in terms of equities, but if you look at what happened, if you looked at the overall return all the way through that approximately 1 century period, if you exited equities when the real return forecast was negative, then what you would have ended up with is a much lower return from Austria. For every country, performance would have been lower, for some a little bit lower, for some a lot lower. And the reason is that forecasting models are difficult to persuade to give you good predictions, and so you miss out on the equity risk premium.
Thank you very much, Elroy. I think in conclusion, first of all, it's very much worth taking a look at the research if you possibly can. More broadly, obviously this casts very great doubt on whether we really can time the market. Now, one of the most famous outcomes of the Dimson, Marsh and Staunton research is that if you buy and hold, you can sit on losses for a very long time, but still this shows that it's very difficult to beat buy and hold as a strategy.